In November 1910, some of the most powerful men in America boarded a private train in New York City. They traveled under false names, used code words, and told no one where they were going. Their destination was Jekyll Island, Georgia, a remote retreat where they spent 9 days in complete secrecy, crafting a plan that would change the world. What they designed on that island became the Federal Reserve Act, and what they created wasn't a central bank to serve America. It was a machine to serve themselves. This isn't some conspiracy theory buried in dusty archives. This is documented history, admitted by the participants themselves years later. Frank Vanderlip, one of the conspirators, later wrote in the Saturday Evening Post, "I was as secretive and yet as furtive as any conspirator." Paul Vorburg called it the most important legislation, not only financial but political, in the history of the United States. Understanding what happened on that island is the key to understanding how America's wealth has been systematically transferred from the many to the few for over a century. The men who gathered at Jekyll Island weren't elected officials. They weren't representatives of the American people. They were bankers, the most powerful financial elite in the world. Senator Nelson Aldrich, whose daughter would later marry into the Rockefeller family, effectively making him the political arm of Standard Oil. A Piatt Andrew, Assistant Secretary of the Treasury, who served as the government's inside man. Frank Vanderlip, president of what would become Citibank, representing the massive Stillman banking fortune. Henry Davison, senior partner at J.P. Morgan Company, the most powerful investment bank in America. Charles Norton, president of First National Bank of New York, and Paul Vorburg, a German immigrant who represented the Rothschild banking interests in America and had studied European central banking systems extensively. These 6 men controlled an estimated 1/6 of the world's wealth. Between them, they commanded resources that dwarfed the federal government's budget. Their combined financial power exceeded the gross domestic product of most nations, and they had a problem that had frustrated bankers for over a century. For most of America's history, the country had operated without a central bank, and there was good reason for that resistance. The Founding Fathers understood the dangers of centralized monetary control. Thomas Jefferson had warned that banking institutions are more dangerous to our liberties than standing armies. He wrote to John Taylor in 1816, "I sincerely believe the banking institutions having the issuing power of money are more dangerous to liberty than standing armies." Alexander Hamilton had successfully established the first Bank of the United States, but it was allowed to expire in 1811. The Second Bank of the United States was chartered in 1816, but President Andrew Jackson declared war on it, famously telling the bank's president, Nicholas Biddle, "You are a den of vipers and thieves, and I intend to rout you out." Jackson succeeded in destroying the bank in 1836, and his words proved prophetic. The hydra of corruption is only scotched, not dead. Abraham Lincoln understood the threat as well. During the Civil War, rather than borrow from European bankers at their demanded 24 to 36% interest rates, Lincoln authorized the printing of debt-free currency called greenbacks. He warned, "The money powers prey upon the nation in times of peace and conspire against it in times of adversity. It is more despotic than a monarchy, more insolvent than autocracy, and more selfish than bureaucracy." Lincoln knew that whoever controls a nation's money supply controls that nation. But the Jekyll Island conspirators saw opportunity in crisis. The Panic of 1907 had shaken public confidence in the banking system, and they intended to use that manufactured fear to achieve what they had been unable to accomplish through democratic means. The panic itself was suspicious. It was triggered when J.P. Morgan and his associates spread rumors about the insolvency of several major trust companies, causing bank runs that became self-fulfilling prophecies. Morgan then positioned himself as the hero by organizing a private bailout, but only after buying up assets at fire sale prices. The crisis demonstrated to the public that the banking system needed reform, but the bankers' proposed solution was like asking arsonists to design the fire department. The plan they crafted over those 9 days was ingenious in its deception. They would create a central bank, but they would disguise it as a government institution. They would call it the Federal Reserve System, making it sound official and patriotic. The word bank wouldn't even appear in its name. It would be structured as a system of regional banks, giving the illusion of decentralization while maintaining centralized control. And most importantly, it would be profitable beyond imagination. The Federal Reserve would have powers that no institution in American history had ever possessed. It could create money out of thin air, with no backing of gold or silver. It could set interest rates for the entire economy, determining which businesses succeeded and which failed. It could manipulate the money supply to create booms and busts, each cycle transferring wealth upward, and it would be immune from government oversight independent, as they called it, though a more accurate term would be unaccountable. Think about the brilliance of their design. When the government needs money, it doesn't simply print it as the Constitution explicitly allows in Article 1, Section 8. Instead, the Treasury issues bonds, promises to pay, and sells them to the Federal Reserve. The Fed then creates the money digitally, literally typing numbers into a computer, and purchases the bonds. The government then taxes the American people to pay interest on money that did not exist until that moment of creation. It's a system where private banks profit from the government's borrowing, and the American people pay the bill through taxation and inflation. Let's follow this process step by step. Say the government wants to spend $1 billion but only has $800 million in tax revenue. The Treasury issues $1 billion worth of bonds. The Federal Reserve creates $1 billion electronically and buys those bonds. Now the government has its $1 billion to spend, but it owes the Federal Reserve $1 billion plus interest. Where does the money come from to pay that interest? It must be borrowed into existence as well, creating an ever-expanding spiral of debt that can never be repaid. This isn't a flaw in the system, it's the system working exactly as designed. This mechanism has been operating for over a century now, and the numbers tell the story of its staggering success. When the Federal Reserve was created in 1913, the total national debt was $2.9 billion. Today, it exceeds $34 trillion. That represents an increase of more than 11,000%. But that's not just inflation or population growth, that's the mathematical result of a monetary system designed to create perpetual debt. Consider what this means in practical terms. Every dollar in your wallet was borrowed into existence. Every single one. That means every dollar comes with interest, attached interest, that must be paid to the Federal Reserve. But since all money is created through loans, there's never enough money in circulation to pay back both the principal and the interest. This creates a perpetual shortage of money, forcing governments, businesses, and individuals to borrow more just to service existing debts. It's a system that guarantees poverty for the many and wealth for the few. But the Jekyll Island conspirators still faced the enormous challenge of getting their plan through Congress. The American people remained deeply suspicious of central banking, and many politicians understood the dangers. The financial elite had tried before and failed. The first Bank of the United States had expired. The second bank had been destroyed by Jackson. 2 subsequent attempts to establish central banks had been defeated by popular opposition. So the bankers employed a strategy that would make Machiavelli proud. They created the illusion of opposition. Senator Aldrich, who had chaired the National Monetary Commission that was supposedly investigating banking reform, introduced a version of the Jekyll Island plan that was deliberately extreme and obviously beneficial to bankers. This Aldrich plan was designed to be rejected, allowing other politicians to propose alternatives that seemed more moderate and democratic. The key alternative was proposed by Congressman Carter Glass and Senator Robert Owen, both of whom were presented as opponents of the Aldrich plan. But the Glass-Owen bill contained the same essential features as the Aldrich plan, just used different language and slightly different structure. The public debate focused on superficial differences while the core structure remained unchanged. Would it be one central bank or 12 regional banks? Would it be called the National Reserve Bank or the Federal Reserve System? Would bankers sit on the board directly or choose representatives? These were cosmetic questions designed to hide the fundamental issue. Would America surrender control of its money supply to private bankers? The deception worked perfectly. Politicians and newspapers debated the false alternatives while the real issue, whether to have a central bank, had always quietly removed from discussion. It was political theater of the highest order, designed to give the appearance of democratic process while ensuring the predetermined outcome. The final push came in December 1913, when most of Congress had already left for Christmas recess. The Federal Reserve Act was rushed to a vote with minimal debate, passed by a skeleton crew of senators and representatives who had time to read the full bill. Many who voted for it later admitted they didn't understand what they had approved. President Woodrow Wilson signed it into law on December 23, later admitting that he had made a terrible mistake. He wrote, "I am a most unhappy man. I have unwittingly ruined my country. A great industrial nation is controlled by its system of credit." The consequences were immediate and predictable. Within 4 years, America was embroiled in World War I, a conflict that historians now understand was largely financed through Federal Reserve money creation. The war debt exploded from $2.9 billion to $25.5 billion, an increase of nearly 900% in just 4 years. This wasn't coincidence, it was the system working as intended. Wars are incredibly profitable for central banks because governments borrow enormous sums to finance military campaigns, and the interest payments continue for decades after the fighting ends. The pattern was set for the century to follow. Every major crisis would be solved by creating more money, which meant creating more debt, which meant transferring more wealth to the banking system. The Roaring Twenties were fueled by Federal Reserve credit expansion, creating the bubble that would inevitably burst. When it did burst in 1929, the Federal Reserve's response was to contract the money supply, turning a recession into the Great Depression. This wasn't incompetence, it was opportunity. During the Depression, the Federal Reserve and its member banks were able to buy assets for pennies on the dollar, consolidating control over American industry. The Great Depression also provided the perfect excuse for the government to confiscate gold from American citizens. In 1933, President Franklin Roosevelt signed Executive Order 6102, making it illegal for Americans to own gold coins, gold bullion, or gold certificates. Citizens were forced to sell their gold to the government at $20.67 per ounce. Once the government had collected the gold, it revalued it to $35 per ounce, representing a massive wealth transfer from the American people to the government and its banking partners. World War II brought another massive expansion of debt and Federal Reserve power. The national debt exploded from $43 billion in 1942 to $169 billion in 1946, an increase of over 600%. The Federal Reserve purchased massive quantities of government bonds to keep interest rates low, essentially printing money to finance the war. This established the precedent for the modern era of unlimited money creation. This pattern has repeated through every major crisis since the stagflation of the 1970s led to greater Federal Reserve authority over interest rates and monetary policy. The savings and loan crisis of the 1980s led to expanded regulatory powers and the concept of too big to fail. The dot-com crash of 2000 led to the era of ultra-low interest rates and asset bubbles. The 2008 financial crisis led to quantitative easing, a euphemism for printing trillions of dollars to bail out the banks that caused the crisis. And the COVID pandemic led to the creation of more money in 2 years than had been created in the previous century combined. Each crisis becomes the justification for expanding the Federal Reserve's power and increasing the money supply. Each expansion of the money supply dilutes the value of existing dollars, effectively transferring wealth from savers to borrowers, from the poor to the rich, from Main Street to Wall Street, from the productive to the financial. The COVID response was perhaps the most blatant example. While small businesses were forced to close and millions lost their jobs, the stock market reached record highs as newly created Federal Reserve money flowed into financial assets. The Jekyll Island conspirators' plan has succeeded beyond their wildest dreams. The Federal Reserve now controls not just America's money supply, but through the dollar's role as the global reserve currency, it influences the entire world economy. When the Federal Reserve creates dollars, it exports inflation to every country that holds dollar reserves or conducts trade in dollars. This gives America the extraordinary privilege of paying its debts with money it creates, while forcing the rest of the world to earn dollars through actual production. The private banks that own the Federal Reserve have achieved a level of power that would have been unthinkable to the robber barons of the 19th century. They don't just profit from their own operations, they profit from the government's borrowing. From economic booms they create, and from economic busts they orchestrate. They've managed to privatize profits while socializing losses, ensuring that their gains are permanent while their risks are borne by the taxpayer. Consider the current situation. The Federal Reserve holds over $8 trillion in government bonds and mortgage-backed securities on its balance sheet. These assets generate hundreds of billions of dollars in annual interest payments, funded by taxpayers. Meanwhile, the Federal Reserve's operating expenses are minimal, mainly the salaries of economists and the cost of printing paper money. The profit margins are unlike anything in the private sector because the Federal Reserve's inventory costs nothing to produce. But this system depends on one crucial element: ignorance. As long as the American people don't understand how their monetary system actually works, the wealth transfer can continue indefinitely. The complexity is intentional, the jargon is designed to confuse, and the structure is deliberately opaque. Most Americans believe the Federal Reserve is a government agency, when in fact it's a private corporation with government-granted monopoly power. Most believe their tax dollars fund government spending, when in fact their tax dollars primarily service debt to private banks. Most believe inflation is caused by supply and demand, when in fact it's caused by money creation. The Federal Reserve has cultivated an image of scientific objectivity, staffing itself with PhD economists who speak in technical language about monetary policy tools and dual mandates. But behind the academic facade is a simple truth. The Federal Reserve exists to transfer wealth from the many to the few, and every tool in its arsenal serves that purpose. When they lower interest rates, they create bubbles that benefit asset holders. When they raise interest rates, they cause recessions that allow cheap acquisition of distressed assets. When they create money, they dilute the purchasing power of savers while enriching borrowers. It's heads, they win. Tails, you lose. That's why understanding the Jekyll Island meeting matters so profoundly. It reveals that the Federal Reserve wasn't the result of careful economic planning or democratic deliberation. It was the product of a secret conspiracy by private bankers who wanted to legalize their monopoly over money creation and institutionalize their ability to profit from economic manipulation. And once you understand that origin story, everything else makes perfect sense. The inflation that eats away at your savings is untainted an accident of economics. It's a feature of the system designed on Jekyll Island. The boom and bust cycles that devastate ordinary Americans while enriching the financial elite are natural phenomena. They re the predictable result of monetary manipulation planned by the Jekyll Island conspirators. The ever-increasing national debt is a sign of government incompetence. It's the mathematical outcome of a debt-based monetary system that was specifically designed to create unpayable obligations. Every financial crisis since 1913 has followed the same pattern: crisis, bailout, consolidation. The crisis creates the excuse for government intervention. The bailout transfers public wealth to private banks. The consolidation increases the power and market share of the largest financial institutions. It's a cycle that benefits the same class of people who met on Jekyll Island over a century ago. History doesn't repeat, but if you don't understand it, it will crush you all the same. The Jekyll Island conspirators are long dead, but their creation lives on, continuing to transfer America's wealth exactly as they intended. The only question is whether enough Americans will wake up to this reality before the system completes its work of converting the entire nation into debt serfs, serving a financial oligarchy. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.